You think you understand the global economy. You think you know who holds the power? But what if I told you that the systems we rely on, the markets we trust, and the currencies we hold are shaped by forces so invisible, so intricate, that most people spend their entire lives unaware of them? Today, we're going to lift the veil and reveal the invisible hands that secretly control the global economy. The truth is stranger, more interconnected, and far more consequential than you've ever imagined. The story begins in the aftermath of World War I, a time when nations were scrambling to rebuild shattered economies. Europe was drowning in debt, empires had collapsed, and the gold standard, once considered a pillar of stability, was under strain. Governments experimented with new economic policies, some daring, some disastrous, but almost all were attempting to answer one question: how do you control wealth on a global scale when the world itself is in chaos? It was during this period that a network of banks, financiers, and industrialists began to emerge as silent architects of economic influence. They weren't elected, they weren't visible in public office, but their decisions shaped international trade, loans, and even political alliances. These were the invisible hands, quietly orchestrating the flow of money across borders. As the 1920s rolled on, optimism surged. But beneath the surface, speculation was running rampant. Stock markets were booming, fueled by credit, international lending, and the promise of endless growth. Few understood that the same financiers who encouraged this boom were also positioned to profit massively from its collapse. The interconnectedness of debt and speculation would soon reveal the hidden architecture of power. Then came the crash of 1929. On a single day, billions of dollars vanished. Banks failed, businesses folded, and unemployment skyrocketed. Governments scrambled, but the rules of the global economy had been written by actors whose motives were often invisible to the public eye. The crash wasn't merely a failure of markets. It was a failure of oversight, coordination, and the unchecked influence of hidden forces. The fallout of the Great Depression rippled across the world. In Germany, economic despair fueled political extremism, ultimately paving the way for war. In the United States, Franklin D. Roosevelt introduced the New Deal, reshaping the role of government in the economy. But even these reforms, seemingly monumental, were shaped in part by negotiations and pressures from banking elites and international financiers, who sought stability without losing control. World War II then reshaped the global economic order entirely. The war effort required unprecedented coordination between governments, industries, and financiers. New institutions were born like the International Monetary Fund and the World Bank, ostensibly designed to prevent economic collapse. Yet behind their public missions were boards of directors and advisory councils composed of individuals whose names rarely appear in history textbooks, but whose influence was monumental. In the post-war years, the Bretton Woods system established the US dollar as the anchor of global finance. This wasn't just about currency, it was about leverage, influence, and the subtle art of setting the rules while appearing impartial. The dollar became the invisible thread connecting economies from Asia to Europe, ensuring that US policy, even indirectly, dictated much of the world's financial rhythm. By the 1970s, cracks began to appear. The oil shocks exposed how dependent the world economy was on finite resources, while inflation threatened even the strongest nations. Yet the responses were not purely governmental. Secretive networks of central bankers and multinational corporations orchestrated interventions, coordinating interest rates, commodity prices, and lending policies in ways that remain largely hidden from public scrutiny. The rise of neoliberalism in the 1980s and 1990s further reshaped economic power. Deregulation, privatization, and globalization created new opportunities for wealth concentration. But this new era also exposed a paradox. The freer the market seemed, the more invisible control was exerted behind the scenes. Complex financial instruments, offshore accounts, and cross-border conglomerates allowed influence to expand without the need for public accountability. The Asian financial crisis of 1997 offered a glimpse of just how fragile this invisible control could be. Nations collapsed under debt pressures, not entirely of their own making. Speculators, international lenders, and opaque financial mechanisms converged in a way that revealed the global economy's hidden fragility. The lesson was clear. Power had shifted from visible governments to hidden networks operating in shadows. In the early 2000s, the housing bubble in the United States began in banks, investment firms, and rating agencies all played roles that were outwardly transparent but inwardly coordinated in ways most people couldn't perceive. The same institutions that lent money and securitized loans were positioned to profit from their collapse. It was a modern echo of the 1929 crash, demonstrating the recurring patterns that shape financial history. When the 2008 financial crisis hit, it seemed sudden, catastrophic, and almost chaotic. But beneath the chaos, patterns emerged that were decades in the making. Interconnected debts, opaque derivatives, and an elite network of decision-makers who moved billions with a few keystrokes. Governments bailed out banks, not merely out of necessity, but because the collapse would have cascaded in ways that the public could hardly imagine. In the aftermath, reforms were proposed. Stricter regulations, stress tests, and international oversight became the new rhetoric. Yet many of these reforms were cosmetic. Powerful institutions adapted, finding new loopholes, creating new derivatives, and maintaining their invisible control while publicly claiming a return to transparency. History, it seemed, was repeating itself. Today, the global economy is more complex than ever. Trillions of dollars move across borders daily, with algorithmic trading, cryptocurrency speculation, and shadow banking adding layers of opacity. Statistics are often misleading. 1% of the global population now owns nearly half of the world's wealth, a fact that underscores the concentration of economic influence in ways both visible and invisible. Modern crises, climate-related disasters, supply chain disruptions, and geopolitical tensions reveal the continuing fragility of global systems. Yet the same patterns of invisible orchestration persist. Central banks coordinate in secret, multinational corporations leverage tax havens, and financial networks exert influence over policy without public consent. The game has changed, but the players remain largely hidden. Consider the rise of artificial intelligence in finance. Trading bots can execute millions of transactions in seconds, potentially shifting markets in ways human observers cannot anticipate. These systems are designed and controlled by a small cadre of developers, analysts, and institutional decisions, effectively amplifying invisible influence exponentially. History, when viewed this way, is not just a series of random events. It's a chain of cause and effect, shaped repeatedly by a small set of actors who understand the levers of wealth and influence. The crash of 1929, the oil shocks, the 2008 financial crisis, they are all chapters in a story of invisible control that spans a century. Yet, there is a paradox. The more the economy is controlled invisibly, the more fragile it becomes. Global supply chains, financial derivatives, and interconnected debts create a system where a single misstep can cascade into disaster. The invisible hands are powerful, but they are not omnipotent. What lessons can we draw from this history? First, transparency matters. The more knowledge is concentrated in the hands of a few, the greater the risk of systemic failure. Second, patterns repeat. Economic crises are rarely random. They are predictable when you understand who holds the levers and how they operate. Third, power is persistent. Even in reform, the underlying networks find ways to maintain influence, often outpacing public oversight. These lessons are not just historical, they shape our present. The next financial crisis, the next economic shock, is unlikely to appear out of nowhere. It will emerge from the same invisible structures, amplified by technology, global interdependence, and concentrated wealth. The question is whether society can respond before catastrophe strikes, or whether we will once again be blind to the forces guiding our fate. As we look forward, the story is far from over. The invisible hands are evolving, using tools we barely understand. AI, cryptocurrencies, and cross-border financial networks may increase efficiency, but they also centralize control in ways that remain largely hidden from public scrutiny. The stakes have never been higher, and the consequences never more real. Understanding this hidden history is not just an academic exercise, it is a necessary step toward awareness, vigilance, and accountability. The global economy is not a neutral system. It is a human construct, shaped repeatedly by those who understand its levers and act with precision, often in secrecy. If there is one truth that history teaches, it is this: knowledge is power. The more we understand about the structures shaping our wealth, our jobs, and our livelihoods, the better equipped we are to navigate and influence them. Ignorance, on the other hand, leaves us at the mercy of forces we cannot see. So, what can you take away from this? First, watch patterns, not just events history repeats in cycles, and understanding those cycles is crucial. Second, question transparency. What appears public is often only a fraction of the reality. Third, understand that global power is both visible and invisible, often operating beyond the reach of conventional checks and balances. The invisible hands will continue to guide, manipulate, and stabilize the global economy, for better or worse. The question is whether humanity will remain a passive observer or an informed participant. Every decision we make, every investment, every policy we support, can either reinforce or challenge these unseen forces. If you've learned anything today, let it be this: the world of finance is not just about money, it is about power, control, and human decision-making on a scale that is almost unimaginable. Awareness is the first step, and action, however small, is the next. Stay curious, stay informed, and never underestimate the invisible hands shaping the world around you.